Hi traders, it's Matt Simpson here from FOREX.com, and today I want to look primarily at the US dollar index because you have the Jackson Hole Symposium coming up. So we'll look at futures positioning and also average returns over previous Jackson Hole meetings, and then we'll do a quick update on gold and even pound Aussie. On the daily chart of dollar index, we can see we had this double top back at the end of July, which resulted in an aggressive sell-off, consolidation and break of that bullish trend line. As a quick recap, on the weekly chart, my longer term view is on the assumption that we've seen quite an important top here for now, and the dollar index could be moving lower as we get into the back of the year. But for now, when you look at the daily chart, there is potential for a bit of a rebound. On that note, we do have a couple of dojis here, or bullish pin bars, but I'd like to iterate that these individual candlesticks don't have a high probability on their own. It should really be taken in context of other forms of analysis. And the fact is that we've got a pretty strong bearish movement here, and this could just be seen as a bear's pausing for breath, and it doesn't necessarily mean when you see these patterns you're going to get an aggressive reversal. However, we do have that important event coming up, and if Kevin Walsh delivers a hawkish tone, then by all means we could well see the US dollar rip higher, at least over the near term. And if you look on the website, I did a more in-depth preview of the Jackson Hole Symposium, but for today we will stick to the charts. And ultimately, we do have support down here from that high volume node from this consolidation area. And we've also got this swing low from the 29th of May, along with these couple of dojis. So at the very least, perhaps we'll get moving up to 99 over the near term. But we need to be careful here because, as I'm about to show you, volatility might be a little bit capped. I'm showing my spreadsheet here of average returns for the dollar index around every single Jackson Hole Symposium since 1998. So the top left chart here are average daily returns, and the blue line being median returns. Top right chart here is the average daily ranges of the Jackson Hole Symposium, and then beneath we have every single high to low range since 1998 for the dollar index. Now translated, the Fed speech tends to be on the Friday. I think out of the entire data set there were maybe one or two that was on Thursday, but for the purpose of now, let's assume that this candle represents Fridays. So this T+1 will be following Monday, Tuesday, Wednesday, and then T-3 would be Tuesday or tomorrow, Wednesday, Thursday, Fed speech being on Friday. And the obvious pattern that stands out is volatility peaks on the day of the speech, which makes sense. And what's quite encouraging is you've got an average range and a median range around the same level of just under 1%. And that's encouraging because it means the data set is pretty much more robust. If you had like a high average and low median, it would mean that we've only had a few data points that were impressive and the rest were not so. The median is a better representation of typical returns, because average is the overall. So the fact we've got median and average close together makes the data set more robust. And that is consistent on either side of the Fed speech. And the other thing that stands out is that volatility tends to diminish leading into that Fed speech. It's pretty low on the Monday afterwards and begins to pick up as the week progresses after the speech. And that is relevant because we've started the week on these low volatility candles, and there's a reasonable chance, if history repeats, that we might get more low volatility. And that's why I'm reiterating that just seeing these candles alone don't always mean we're going to get a solid rebound. So if I was looking at it from a strategic point of view, traders might want to be a little bit more cautious of the potential volatility leading into it. For example, intraday timeframes might be a better match unless we get a brand new catalyst that makes volatility increase. As for the Jackson Hole analysis, notice that Fed speech has averaged negative returns of minus 0.16%. That's not huge, but it does show a slight downwards bias, and the median is effectively flat. So what I could deduce from that is that whilst volatility gives a clear pattern, returns do not. And to me, that suggests the pattern volatility is more robust than the ones of returns. In fact, we could say that because these returns are so small, it's effectively a coin toss as to which way things would go. And that's useful information to know, even if it's not what you want to hear. If you look at the bottom chart, it shows the volatility of the dollar index on the day of the speech since 1998. And interestingly, we've got more prints here that are beneath one standard deviation of the sample. We've only got 3 or 4 that are at or above one standard deviation. So it's not like this is going to guarantee explosive results. And if you read the article I mentioned before, I highlight how actually there's a decent chance that Kevin Walsh won't actually announce a policy change. So it really is down to what he delivers and how markets interpret that as to how explosive that move could be and which direction it goes. But in a nutshell, we've got a pretty good level of support here, some potential reversal candles. We've also got traders that are heavily net long. Futures market shows that traders were heavily net long last week. Admittedly, this data misses out the bearish sell-off on Wednesday, but overall, considering the depth of the US dollar pullback, futures traders do seem to be relatively net long overall. So who knows, perhaps the path of least resistance for the dollar is up over the near term. Of course, if the dollar goes up, gold could pull back. Now, I've covered this in prior videos, and I was looking for some sort of bullish reversal since the end of July. It finally came, and it's been pretty impressive. In fact, I would say it's trading more like a stock than gold at the moment. Now, I like that it's kind of come perfectly into this high volume node around 4,700. But ultimately, when you have a market that's lost around a third of its value, then had this explosive move to the upside, the psychology of this market has changed. And I still think there's probably plenty of people sat on the sidelines regretting not being in this, which is a nice way of saying there's people potentially looking to buy if we do get a pullback at all. And then when you see bullish engulfing candles during an uptrend, to me that's a pretty good sign of bullish demand. So whilst prices hold above these lows, I suspect some traders will be looking for dips, and a movement up towards 5,000 doesn't seem that impossible all of a sudden, considering it's around 2/3 way there anyway from the 4,000 level. Of course, a downside risk to that should be if the US dollar goes on an absolute rampage, but even then I'm finding it hard to build a case where the gold simply rolls beneath 4,000. To wrap up on pound Aussie, as price action is really interesting. We had this nice bullish trend from these lows, but momentum has clearly changed, got this lower high with a shooting star reversal candle, and then after a false move higher on Thursday, we had a near bearish engulfing candle. It's close enough, but ultimately I'm looking at this as another lower high relative to this one, relative to these highs here. So there's a clear support level there for bears to be keeping an eye on around 190, and a break beneath it could open a potential run back towards these lows here. If we did get prices break above 192, my near-term short bias is invalidated. As always, hope this is useful. Wish you best of luck with your trading.